What is important when you're managing a business, or if you are in the process of starting a big project or a business, to be able to make connections between financial statements and the value chain of the organization and the organizational structure and also the strategy. In this presentation that I'm calling Strategic Connectivity Part 1, I am going to talk about some of these concepts and help you think through the connectivity as you are going through your finance class and eventually are going to be learning about strategy, and so this will help you start to make those connections as you go forward into your future classes. In the MBA 640, you will be learning about the strategy, which is a course that comes right after this. And here in this class, in the finance, what I want to do and the major learning outcome is that students understand some of the formulas, some of the concepts related to finance. But every so often, I will also talk about connectivity with the strategy. So as you get into MBA 640, you at least will have some feel for it as far as the connection is concerned between finance and strategy. So I'd like to start out by highlighting that even though obviously all financial statements are important, and as you have learned about 4 key financial statements: income statement, balance sheet, cash flow statement, and retained earnings. But when it comes to strategy, when it comes to looking at how the business is running, the focus that management puts their time and effort on is income statement and balance sheet. The cash flow statement, retained earnings, is really the outflow of those 2 statements. Now, in this presentation, I am going to focus on the income statement. And what are the pieces of the income statement? Because the income statement is more specifically the pro forma or the forecasting of income statement is a key part of evaluating a project or even the whole business evaluation. And also looking at the sustainability of a business as far as how well it is doing or will survive. One has to also be able to do a pro forma for the income statement to see how much profitability we think the business is going to generate over the next, typically you forecast with 5 years. Thus, the company's management team has to effectively manage their value chain to yield profit margin. And, so what do I mean by value chain? A value chain is, the simplest way to think about it, let's say you are looking at a computer company, and the end product that the computer company is providing to the customer, let's say, is a laptop. But to get to that point, company has to go through certain phases. So there are elements of value chain that are included in making a computer. For example, part of the value chain is to be designing a computer, all the way from components of the computers, like the keys for the keyboard, the touchpad for the moving the cursors around, the screen, LCD, LED, what screen they're gonna use, the body of and the frame of the computer. So all are those individual components that have to be designed and to be able to then eventually make it, and then eventually also put it together. And then they test it, so that's part of the value chain, and then they eventually pack it and ship it. So each business provides something, a product or a service. So the management team's job is to really manage that value chain. And so when you are in a business, or if you are looking at a case study, obviously you're thinking of it in terms of how effectively the management is managing that value chain. Okay. Now, so what I'd like to do in this lecture is to cover a couple of key concepts. One is the connectivity between income statement and value chain. I touched on it a little bit. I'll talk a little bit more about it. Well, more important for this particular lecture, the connectivity between income statement and the organization. Because remember, at the end of the day, it is the organization, the people that are in the building blocks of the organization, all the way from the person who's running the business to all the functional departments, marketing, accounting, sales, engineering, so on. We want to do is to be able to understand that, because when you as a business leader in an organization, when you are asked to make the business better, the first step is to basically say, let me look at the financial statements, and you want to look at the income statement, and you're going to look at the balance sheet. And when you're going to start to focus on the income statement, you will have to find ways to make it better. But it is valuable to understand who's driving these pieces of income statement, because if you do, at least you know who to talk to, how to put it all together. Okay. Now, so here is an example of an income statement. It is simplified, and as far as business strategy and as far as some of the financial analysis is concerned, one can do at a pretty consolidated level income statement, which this example is. So you have sales, which typically you will have for any business. That could be a product or non-product. Then you will have cost of goods sold, which is your, the amount of cost it takes to produce that product that is directly related to producing the product. It could be, some companies will call it cost of revenue instead of cost of goods sold. And typically, when the companies are providing a service and they're not producing goods, tangible goods like a machine or a auto, they may be providing insurance services or insurance products, then they may call it cost of revenue. But the important part is, when you're looking at the income statement, is to focus on the next line, which is typically called gross margin. Now, in some companies, if it is very, very manufacturing focused, you may find it will say manufacturing margin. So the nomenclature of what it is called is less important. What is important is, what is that number? So what that number in this example is $13 million, and which is your sales, and you're subtracting all the costs to provide the product or service, and you're left out with $13 million. Now, from there, you have this money left over to pay other expenses within the organization, and hopefully, eventually, in the end, you have some positive net income. So in this example, their activity that is related to selling general administrative type costs is $3.67 million, so that's an expense. Research and development is $2.1 million, so that's an expense. So from there, the next place you will kind of draw and take a pause and look at the sub-element is called EBIT, earnings before interest and taxes. So in this example, it is $7.23 million. Next will be that we have to pay interest. So we have a debt in the company, and hence we are paying interest on the debt. So this is the interest paid on the debt. Just a quick reminder, typically most businesses loans are interest only, so this is not the amortization piece of it. This will not include any principal that you're paying back, because that's your own money you're paying back, so that's not an expense. The expense is the extra money you have to pay to the bank or your lender for the interest. So the interest is what is in there. The next place in the in net income statement, you take a pause. It is the EBT, earnings before taxes, to see how much money do we have left now. In this example, it is $7.02 million, and then we pay taxes, and we get net income of $52650. The other thing that, as you have learned in the prior modules, is the common sizing can help. So the business, one thing to do is to kind of look at it in terms of, to say, okay, I want to at least get a feel for where are my big cost drivers. So here in this example, cost of goods sold, which is 67.5%, which is really mathematically 27 million divided by 40 million of sales. From there, if I look at the gross margin, which means that for $100 of sales that I have accumulated from my customers, for every $100 of sales, I am left with $32.05 after I have used the money to provide and make the product. From there, I'm spending $9.2 for every $100 of sales in SG&A, $5.3 on research and development, the engineering type functions, and now I'm left with $18.1 per $100 of sales, which is my EBIT. So I'm still positive that I have to pay the interest, then it comes down to the EBIT, then I pay taxes, and so my net income is 13.2%, and typically that number is called a profit margin. Now, the value of looking at it when you're analyzing a company and an income statement is that it kind of gives you an easy visual picture, and especially if you can show it graphically, that is shown in the middle of the PowerPoint. That you can see where the big drivers are. Now, it is also critical that not only one just look at 1 year, one column like shown here, but you look at it also. So this would be a vertical analysis. Obviously, you're looking at it vertically. But you also want to bring in the element of horizontal analysis. And by that I mean is look at the income statement for this company for historically for the last 3 or 4 years to see if the contents are going up or down. For example, is the cost of goods sold as a percent of sales for every $100. For this year, it is 67.5. Has it gone up or down? So this way, when you're looking at it vertically, which is this column, and then looking at it horizontally, which means you lay out 3 or 4 years, you can it'll give you some perspective and be able to help you think to say, okay, if I want to come up with some kind of a strategy, some kind of a game plan, where would it be? So that's really the value. Now, the second value is also for common sizing, is when you're doing it within the company, when you're looking at it vertically along with horizontally by mean is that you're looking at it multiple years, you will have, instead of one column, you will have 3 or 4 or 5 columns. You can kind of see the trend. But it is also important to see how well is this company doing compared to the peers. So if you are working, let's say if you're looking at analyzing, let's say General Motors, and you're looking at their high-level performance, looking at their common sizing, etc. Now you want to compare it to another company like Ford or Toyota or Honda, and because those companies may be different size, maybe in the sense that they could have higher level of revenue or less compared to GM, the common sizing helps us normalize it. So the other thing you also want to do from a strategy perspective is also look at it. Comparing it to another company. Okay. Now, so obviously any company is run by people, and so there is an organization structure, and the organization structure may vary depending on the product or the industry. For example, a organization for Apple Computer may look a little different than say General Electric or IBM, but regardless of the not being exactly the same, some of the pieces are going to be the same. And that will depend on the value chain. For example, there will be somebody who's running the business, there will be sales and marketing, there will be finance and accounting, you need the human resources, engineering, operations. So majority of the common denominator are going to be the same, but if you ever have a chance to reflect on the organization and the company you work with, what you will start to see, there may be little differences. For example, some companies may not have a high content of engineering, so they may not have a separate box. It could be small enough that they can put it under like operations, for example. Some companies may not have a huge operations function. They may be more design type companies, so they are more focused on design, so they may not have an operations box by itself. It could be buried under some other function. But overall, I think what is important when you're looking at the organization, you're really thinking in terms of the value chain. So in this example, basically what I am using, which is the, based on the Gen Inc. case study that you are, following through the class, part A, part B, so on, that the organization structure has operations because it has an element of manufacturing, that it has manufacturing, purchasing, quality, typically will fall under operations. Then you have sales and marketing, you got finance, you got HR, engineering, and other G&A functions. And this organization basically is managing the income statement. And the value chain will be, depending on the industry, depending on the company, There could be, a larger value. For example, the example one I used earlier about the computer, all the way from designing the components of keys and LCD screen to all the way to designing the whole system, and then be able to manufacture the parts or purchase the parts and be able to assemble, and then eventually be able to package, ship it, test it, so on. So there could be sub-elements of the value chain. And the organization basically is managing those value chains, and then based on understanding where the cost structure is and who is managing it, it kind of makes it a little bit more plausible that somebody above, in this case a general manager or as a consultant, they can start to get a feel for it, to say, okay, how do we try to get our mind around the cost structure and the organization structure. So what I like to do is to talk about a typical financial planning process at a pretty macro level, pretty high level, but I think you will have a pretty good understanding of how the organization and the income statement is connected. So this process is typically done in all great organizations, be profit or non-profit. They go through this organization, which is putting together a financial plan and creating the budgets for the organization. So the financial metrics obviously play an important role in running a business. If you don't know where you are, you have no idea if you're getting better or worse. So when the companies go through this process, typically it is done in the latter part of the prior year. For example, if companies who are going to plan for, say, 2020 and 21 and 22, next couple of 3 years, they're going to start to put a major focus in 2019, sometime in September, October timeframe, and they're going to start to lay out a plan. And based on that, they will set some objectives for the budgets, for the departments, for how much money they can spend and where they can spend it. And also the process allows them, as they're managing it from month to month and quarter to quarter, if things are changing external to the company or internal to the company, for example, if the economy is getting worse or they lost a contract or they want a new contract, they want to make some adjustments to their plan. And so it is both short-term and long-term. Short-term could be quarter by quarter and up to a year, and the long-term could be somewhere between 3 to 5 years. And hence, because of importance of this knowledge, it is important that all, even non-financial managers and supervisors in an organization should have some financial literacy. And that really is some of the things that you are all learning, even though most of you may not be in a finance function in the organization. You may be dealing with somebody in finance, but if you understand what process goes through and how directly or indirectly you and your department is involved, I think it's going to make you a better business leader. So it also helps align metrics for overall business performance. So let's start with the process. Typically, if it is a publicly traded company, instead of setting a target for net income, they will set a target for earnings per share. And the reason is because the publicly traded company, they have to report their profitability every quarter, and then obviously in more detail at the end of the year. And some of the numbers, if you ever come across earnings announcements for a publicly traded company, you will see they talk a lot about earnings per share. So that's the reason the conversation will start at a top level management. They said, okay, our earnings per share this year was, let's say, $5. Next year we want to make it 10% better, so it should be $5.50. What that means is basically what they are doing is they're really setting a net income target. Because the earnings, which is synonymous to net income, per share is really nothing more than taking the net income and dividing it by number of outstanding shares for that company. So if you were dealing or working for a company that is not publicly traded, they will not talk about earnings per share or net income per share. They will start at net income. But obviously you can see there is a direct connectivity between net incomes and earnings per share. Typically, most times the number of shares don't change very much. They could, but typically they don't, and hence there is a strong correlation, obviously by default, between the earnings per share and net income. Now, if you know the net income, and you know your tax rate, average tax rate for the company from the prior year, or whatever information you may have for some changes in the tax codes for the following year, the companies, once they have set a target for net income, they pretty much can back calculate how much taxes they are going to pay. both state, local, federal, so on. So they can pretty much set a dollar value for that number. Now from there, obviously, you mathematically can figure out what should your profit be before taxes, or what should your earnings be before taxes. Because if I know my net income, what I want, I know what taxes I'm going to pay. So obviously, EBT is going to be, a net income minus taxes. Now from there, you then have to say, okay, I know I have debt, or at least I have a pretty good feel for how much my debt is or will be for next year. I know what the interest rate will be. You can come up with the interest expense. So you can see that once you have set the target for net income, or earnings per share, you basically can start to lay out some of the pieces that you want to budget for. Now you get into earnings before interest and taxes. So as you can see, what I am really doing is I am walking you through a net income, but in reverse. Because at the end of the day, what we really want to do is to improve the net income. And that's the reason I think it is good when you think through in an opposite direction, you can start to see. Now, the other thing that you may come across, and depending on the company you work in and depending on what department, what function you are in, you will find that at the organization's level, that the focus is going to be that the management team is going to have a target to improve EBIT. And in one of the case studies I mentioned, why interest expense and taxes are not part of the operating management budget, and the reason is because if you already have a debt, you're going to pay interest expense in the short run anyways, at least for the next couple of years, and the taxes are going to be based on the tax laws. But the EBIT, every element that goes into the EBIT is manageable by the management team. So what are the pieces that go in the EBIT? Now, if you recall from the income statement, you got the sales. Obviously, this is the, we get it, money that we get from our customers. Then there is a cost of goods sold, which is the cost that we have to spend to provide the product that is directly related to making or, selling the product. Then you got the SG&A type activity. That is a cost. Then you're going to, depending on the company, if there is engineering, R&D. So you can see that this really is an income statement shown visually. So when you are thinking about, either be a strategy or so this is really income statement. If you think about it, this is the income statement right now. But the problem is that if you stop here and don't continue the conversation, then it becomes a little bit difficult to where do you go, start to probe into taking some action. So now let's look at each of the components, again at a macro level, but hopefully you'll get a pretty good feel for it. So you have sales, which has got two pieces, obviously price and quantity. How many we're going to sell at what price, and there could be more than one product, and each will have a price. So from a strategy perspective, if you are going to be looking at your marketing strategy, etc., what you want to do is to say, how does it affect either the price or the quantity? Because obviously, if either one of these change, is going to change the sales. It could be positive or it could be negative, but your thinking process to improve the sales will eventually have to come from price and quantity. How's the competition doing? What does the industry look like? This is where you're going to start to think about eventually as you get into the future classes. It's how do you start to think about, the Porter 5-4 analysis or the Porter's generic strategy. So this is where I'm trying to, just start to talk about this conversation that as you go through in the strategy class, you can start to see the connectivity. But the whole idea as a manager is to be able to look at each of these pieces. Now, so let's look at some of these costs. Obviously, the cost of goods sold is coming from manufacturing, procurement type quality costs. You have labor costs, you have purchasing costs, and obviously you'll have quality costs and, cost that is related to making it. Now, so if you are going to be focused on improving cost of goods sold, then obviously you're focusing over here. But then your strategy needs to be related to, these pieces, either one or all. So you have to be very, very clear in what you're going to do and how much will this or this or this basically get better. Because if these get better, obviously your budgeting is getting better and this is getting better. Okay. Similarly, if you look at some of the SG&A functions, which basically is your administration management type people, you got HR people, you have your finance, sales and accounting, marketing, your finance and accounting, and then eventually engineering. So if you want to improve your earnings per share, or let's say start at net income, you cannot do much here, at least in the short term. You cannot do much here. You can in the long term. Obviously, you want to pay your debt down if you wanted to, but in the short term, there's not much you can do. So the management team really is focused on this. In order to do that, they got to enhance this, somehow make this better, this better, this better. And if they do that, this will get better. But in order to improve sales, they need a strategy to focus on price and quantity and do the analysis to see what happens. On the other hand, as you are looking at did the part B, if the economy is getting softer, which it does in the Gen Inc., then obviously the prices are going to drop. So what do you do? And I think when you did the exercise, you probably found that as you move some of these assumptions around, the EBIT changes and eventually the net income changes. So keep in mind as you go on through it. And even if you have a strategy to improve SG&A, you want to be able to articulate where you are going to do what and how much will that change. And because if you cannot identify the areas where the changes will take place, then obviously you cannot really quantify what this is, and same thing with the engineering. So, and there could be other G&A functions sometimes, so keep an eye on that, in the business, and I think I threw an example in the case study. So now, eventually, from net income, you obviously focus on cash flow, and then we will talk more about cash flow, maybe in a different lecture, and also obviously you're already aware of it based on the MBA 633 that you have taken, and also chapter 2 that you read in the CFIN. But overall, cash flow will come from net income. You add back the non-cost, which is depreciation, and all that is obviously coming from net income. So the reason this is important to understand, because it connects to the organization structure. This leads to this. This leads to this, and eventually leads to net income. From there we get the cash flow, and then we can start to see. Now there are other components of cash flow, as you know. Inventory, amount of money we tie up, will consume our cash. So accounts receivable, same thing. Accounts payable will be the other way around, because our suppliers are giving us material on credit. Then you have dividend if we pay to the shareholders, or any investments you make to expand your company and so on. So understanding this income, net income, all the way understanding all these pieces are really, really important to understand this thing. Okay. Now, not that inventory and accounts receivable is not important. They are important, and you want to manage it. But at some point, there is so much you can do. You cannot go to negative inventory. So what happens is that long-term growth for the company comes from net income, because you can continue to create net income if your business is very, very successful and have a positive cash flow. Now, we'll talk in a different lecture, but cash flow is directly proportional to, in terms of the value of the company. So when we talk about in the later lecture, the valuation of the company, etc., you will see the cash flow becomes important. But all that stuff is tied to income statement, which is all tied to functions, which all is tied to, obviously, the people that are managing the business. So working capital are those typical pieces. So what you're going to find, inventory and accounts receivable, accounts payable is called working capital. Why they're called working capital? Because that's the money that you basically need to be able to run the business. Bill inventory, support the accounts receivable, accounts payable, etc. Okay. Now, in the example of Gen Inc., what you did as part of the exercise, you created a budget, for this group. And what I'm showing over here is the same budget, except more in the form of percent. So this gives you another way to look at it. A total budget obviously will be 100%. Direct labor, they're spending this much. Then you have this much for salaries and wages, etc. So you can see, depending upon how you want to cut it, you can cut it from an operations perspective, sales marketing perspective, finance and accounting department, HR department, engineering department, other G&A budget, the general manager's office, and so on. And you can look at the budget this way. You can also start to look at the category direct labor, salary and wages, where it is. So this connectivity kind of gives you a pretty good feel for where the money is being spent. So if you are going to set a strategy, you'll have to identify where in these boxes, the category, your numbers are going to get better or worse as you are planning for the future of the company. This chart, basically what I want to do show over here is from a management perspective. Obviously the connectivity is between the organizational structure, somebody running manufacturing, procurement, quality, sales, marketing, finance, accounting, HR, engineering, and so on. And here are some of the key financial metrics that are important: sales, manufacturing costs, SG&A, R&D, and from a key working capital, inventory, accounts receivable, accounts payable. So what are things in your organization, or typically in any organization, if you are a leader or a manager or a consultant for the company, you want to be able to see who here in this organization, the department, is really driving these or responsible or accountable for. So I'll give you an example. So the example here is that typically, and again this is not 100% because it will depend on the value chain of the company and will depend on the industry and so on. But typically what you're going to find, the sales. Obviously, marketing and sales is involved because they have to figure out where the selling should take place, etc., etc. So they would be, P is basically one of the primary responsibilities. But if it is something where it has to be produced and sold, from a management leadership perspective, you are going to expect the operations people, which includes these three categories, to be also responsible, because if they don't make quality product and ship it on time, obviously they will not get the sales. So typically what you're going to find, the sales part of the financial statement is really focused on these. Now, sometimes in some companies, engineering may have some role too. So you'll have to see and ask and depend what it is, and maybe it may not be a primary, it could be a secondary. So as you are understanding a company, especially your own company, see what are the organizational structure, but also see, who do you think is going to be responsible and accountable for. So for example, if you were a director of manufacturing, operations, etc., and you were responsible for this, I'm pretty sure in your objectives, you will have some targets for the sales for that particular year, along with the marketing and sales, maybe as the jointly owned targets. And there could be an engineering function that you may need help from, and they may have quote unquote, secondary objectives tied to it. Cost itself obviously will be managed by operations people, and sometimes you will also find engineering plays a role, because if they can help design a product that is easier to make, it will cost less. SG&A activity will be the budgets in each of the SG&A function. You got your marketing and sales, you got your finance and accounting, you got HR, other staff functions. So those where, once the budgets are given to them, and I think as you are learning through the Gen Inc. case, they have to manage those budgets to make it happen. R&D typically will be engineering, but sometimes, depending on the company, depending on the industry, you will also find that the engineering needs to create some development hardware, some testing hardware. In that case, manufacturing, procurement, quality will play some role, working with the engineering to be able to effectively maybe find or make testing product at the effective cost. On the working capital side, inventory obviously is mostly in the operations, so you will see it is really managed by the operations function, which is the manufacturing, procurement, and quality. Accounts receivable is the money that our customer owe us. Now, depending on the company, marketing and sales will be involved. Why? Because obviously they are mostly directly connected to the customer, so they will play a role. And the finance will play a role because obviously they have to bookkeep, etc. Accounts payable is the money that we owe our suppliers. So who will be responsible for it? The procurement people. Why? Because purchasing organization is tied with the supplier organization, and again, finance basically in this case also will do it in terms of tracking the data, how are they doing, and so on. So what are some of the key takeaways for this particular conversation that I had? First, financial performance, i.e. income statement result, of how effectively is the overall value chain managed. So really, how effectively are we, the management team, or how is the company managing value chain is really, really important. The components of income statement that I talked about, Obviously, you have to be aligned with the departments responsible, because if they are not, then you don't know who is accountable and responsible for what part of the income statement. As I mentioned, it will, it will cross function. You could have sales be obviously managed, and the accountability, if you are the boss, basically give it to the director of sales and marketing and also director of operations, that hey, you two have to go make it happen. So the reason all that is important is when you're going to start to think of any strategy, alliances, acquisition, etc., you have to basically develop and enhance your financial performance. So which means, where is it going to come from? When you say I'm going to improve the financial performance, you have to look at the ingredients. Are we going to increase the sales? So we have to have a strategy, and we can provide some clarity. Is why will our strategy increase the sales? Is it going to increase the sales because we're going to sell more, which is a quantity part of the sales? So remember, sales is price times quantity. Or is it going to be because we are going to increase the price for, maybe we have some key elements of our in our product that we can use to raise the price. So, but it's got to be very, very clear with how the sales are going to go up. And then they look at the cost. If I'm going to sell more and make more, how much is it going to cost me? Because eventually what you want to do for every strategy, you have to look at all the elements of the income statement and decide which ones will change and why and how much. Which ones, some may not change. For example, you're not going to go change the tax rate or interest for the expense. Some of the elements may not change, but some will change. So what you have to do is to identify which ones will change and why, and also be able to forecast over at least the next 5 years what would they look like. Because at the end of the goal of a strategy, any strategy, is to enhance cash flow. And where does it mostly come from? Income statement. Yes, some will come from inventory and so on, but mostly it's going to come from income statement. But again, where will the enhancement come from? Is it going to come from revenue? If so, which is your sales, which is going to grow? Why? You have to provide, again, I'm talking about taking my finance class, but also expanding your thinking as far as what is happening around you and what you're going to start to see as you move forward in this program. Is it coming from cost? It's coming from both. If it is cost, what costs? Are they going to go up? By how much compared to the revenue and so on? So creating the before, which means before your strategy and after your income strategy, will give you a quantitative value or how you are going to enhance your strategy.